Let's talk about 8 cheap dividend stocks. I'll start with the least undervalued and work my way up to the largest potentially discounted dividend stock. First up is US Bancorp, ticker symbol USB. The company has grown its dividend for 14 years now. It currently offers a pretty lucrative forward dividend yield of 4.51%. The payout ratio is a respectable 48.54%. And it has a decent 5-year dividend growth rate of 4.07%. Let me jump over to my price to earnings ratio valuation tool to see just how cheap USB is today. The stock trades for $44.23 and appears to be 7.89% undervalued with a fair price of $48.02. This valuation is calculated by comparing the current PE ratio of 10.95 to the trailing 5-year average ratio of 11.89. The 20% margin of safety undervalued range, shown by the blue line in the valuation chart, gives us a target price of $38.41. And we can see that about a month ago, USB was slightly below this threshold. The stock has bounced higher over the past month, much like the entire US equity market, but it is still marginally undervalued today, based on its 5-year history. This valuation tool is built in a Google spreadsheet, and it's powered by ticker data that allows me to automatically run a historical PE ratio analysis for any stock I want. If you would like to grab a free copy of this spreadsheet, there is a link in the description below. Ticker data is a paid service, but you can test out the service for free with a 7-day trial. I have a referral link in the description below if anyone is interested in signing up. Ticker data allows you to automatically import a ton of financial data into a Google spreadsheet in a matter of just seconds. This valuation tool is just the tip of the iceberg of what you can do with ticker data. Alright, let's move on to the second dividend stock, which is Accenture plc, ticker symbol ACN. The company has grown its dividend for 5 consecutive years now. It pays a reasonable forward dividend yield of 1.84%. The payout ratio is a very healthy 46.47%. And the stock has a pretty strong 5-year dividend growth rate of 8.22%. Let's pull it up in the PE ratio tool to see how attractive valued it is right now. Accenture currently trades for $320.41 and appears to be 10.17% undervalued with a fair price of $356.67. The current PE ratio is 26.19, which compared to the broad equity market may appear slightly expensive. However, relative to the company's 5-year trailing average of 29.15, it appears attractive. From the valuation chart, we can see that Accenture, similar to USB, was sitting around a 20% discount just a few weeks ago, and appears to be headed back towards a fair valuation. The third dividend stock we are going to look at today is T. Rowe Price Group, ticker symbol TROW. T. Rowe has a 38-year streak of dividend growth. It currently pays a healthy forward dividend yield of 5.23%. The payout ratio is a very reasonable 54.36%, and the company has a robust 5-year dividend growth rate of 9.43%. From my PE ratio tool, we can see that T. Rowe currently trades for $97.32 and appears to be 25.35% undervalued with a fair price of $130.37. T. Rowe's PE ratio is 10.72, which is pretty cheap relative to the broad market, and considerably lower than the company's own 5-year average of 14.36. Similar to the prior 2 stocks we looked at, T. Rowe's share price has rebounded from its most recent dip in mid-April, but it still sits well below the 20% undervalued range. The fourth dividend stock today is Pepsi, ticker symbol PEP. Pepsi has an outstanding 52-year streak of dividend growth. It sports a very nice 4.37% forward dividend yield. The payout ratio is a reasonable 67.5%. And the company has a very good 5-year dividend growth rate of 7.25%. From my PE ratio tool, we can see that Pepsi currently trades for $128.45 and appears to be 27.41% undervalued with a fair price of $176.96. The current PE ratio of 18.81 is sitting well below the company's 5-year average ratio of 25.96. Unlike the prior 3 stocks, Pepsi has not rebounded since mid-April. The stock has actually continued to decline. It has actually declined since mid-2023, but only more recently has it pushed below our target 20% undervalued range. The fifth dividend stock today is West Pharma, ticker symbol WST. The company has a very long 31-year streak of dividend growth. It pays a rather weak forward dividend yield of just 0.39%, but it has a very low payout ratio of 12.35%, and a decent 5-year dividend growth rate of 5.67%. The PE ratio tool shows us the stock is currently trading for $206.69 and appears to be 28.13% undervalued, with a fair price of $287.57. The company has a rather high PE ratio of 32.24 relative to the broad equity market, but West Pharma has historically traded for a rather elevated PE ratio. From the valuation chart, we can see the share price plunged in February of this year, declining by more than $100 and pushing the stock below our target 20% undervalued range. The sixth dividend stock today is Target, ticker symbol TGT. Target has the longest dividend growth streak of all 8 stocks we're looking at today, standing at 56 years. It pays a very nice forward dividend yield of 4.52%. The payout ratio is a very healthy 50.11%. And the 5-year dividend growth rate is the best we have seen thus far at 11.16%. The PE ratio tool is showing the current price for Target at $95.26, which appears 42.83% undervalued, with the fair price being $166.63. Target's PE ratio has declined all the way down to 10.72, which is pretty cheap compared to the broad equity market, and Target's own 5-year average of 18.74. Similar to Pepsi, Target has not really bounced back since mid-April, but its price decline did start well before the latest tariff-related market sell-off. From the valuation chart, we can see that Target dipped below our 20% undervalued range in late 2023. It then had a nice recovery towards the end of the year and into 2024. And in late 2024, the price dipped again, followed by a marginal recovery, and the latest dip that started in mid-February. The seventh dividend stock today is Nike, ticker symbol NKE. Nike has a respectable 23-year streak of dividend growth. It pays a reasonable forward dividend yield of 2.56%. The payout ratio is a healthy 50.83%, and it has a pretty good 5-year dividend growth rate of 10.61%. The PE ratio tool is showing us a price of $61.73 for Nike today, which appears to be 44.01% undervalued compared to the fair price of $110.24. Nike's PE ratio of 20.51 is about where the S&P's PE ratio sits right now, implying it is not cheap compared to the broad market. However, Nike has historically traded for a higher multiple than the S&P, implying that relative to its own history, the stock is trading for a pretty steep discount. The company's troubles started in late 2021, when the stock peaked at around $177. 2022 was pretty brutal, but finished with a marginal recovery. 2023 was sort of flat, but since 2024, the stock has been on a downward trend. Some of this is related to stagnation in earnings, but the company certainly deserves a closer look, especially for those that have an optimistic outlook on its future growth potential. And the final dividend stock today is United Health Group, ticker symbol UNH. The company has a 15-year streak of dividend growth. It pays a historically high forward dividend yield of 2.7%. The payout ratio is a very low 30.04%, and it sports the highest 5-year dividend growth rate amongst the 8 stocks we are reviewing today at 14.22%. The PE ratio tool also suggests it is the most undervalued stock, with the current price of $308.01 being 47.46% lower than the implied fair price of $586.24. United Health Group's PE ratio currently stands at 12.66, implying it is relatively cheap compared to the broad equity market, and more so to its own 5-year track record. The company's share price plummeted since mid-April by nearly 50%, following some less than desirable news, with its CEO stepping down and suspended guidance. The stock is currently trading for its cheapest valuation in the past 7 years, and certainly deserves consideration. There you have it. 8 dividend stocks, all potentially undervalued, some with very healthy yields, and some with nice dividend growth streaks. In my opinion, you have to consider three things before investing in any stock. The first is whether or not you believe the company is a quality business. The second is whether the stock is attractively valued. And the third is whether you believe the stock can offer a lucrative rate of return in the future. I hoped you figure out the second part today. And if you'd like to learn more about how to identify quality businesses and how to calculate future rates of return, you can check out my newsletter, where I have written about these topics extensively. There's the link in the description below. I hope you enjoyed the video. If you did, please leave a like and subscribe to the channel. Thank you for watching and see you next time.